Hello student, today we are starting a new chapter which is related to financial management, and more specifically we call it working capital management. The topic is one of the most important topics in which we deal that how firm manage their operating activities and how their liquidity is impacting on their business decisions and their profitability. Working capital is a quite technical and lengthy topic. I will try to cover in two lectures. The one which I am presenting right now, this will give you a basic introduction of the concepts, and once your basic concepts will be developed, then we will move to more activities related to this chapter. Technically, there are two terms that might be used in the concept of working capital. The one is called gross working capital, means total investment in current assets. So if you are specifically interested in gross working capital, then you will take care that you can only take current investments in the total investment in the current assets. But if you are interested in the net working capital, then student, you will take all current assets and you will minus current liabilities. But generally speaking, whenever we use term working capital, like the way it is given over here, then this working capital means we are only discussing net working capital. So general assumption that you will keep in your mind that if your teacher is discussing working capital, or if question is asking you to work out working capital, so it doesn't mean that you are actually working gross working capital. In common sense, we take working capital in the form of current assets minus current liability. So from this time and onward, when we are discussing working capital, it means we are talking about current assets and current liabilities. These are the general concepts that are directly attached with the accounting concepts. So that should be in your mind that if you are dealing with the current assets, so these are the common items that you might face in current assets: cash and bank balances, marketable securities, receivable and inventory. Though there are many other items that might be recorded in current assets, but when we are dealing with the working capital, you can keep it in your mind that these are the important items that uh, is taken for current assets. And here I'm taking these three concepts: account payable, accruals, and bank overdraft. Remember that overdraft may also be taken as a running finance, but generally there are two popular titles that you face in your study. The one is account payable and the second one is accrual expenses. If bank overdraft or running finance is given, then you can also include it over here. Now, suppose I'm giving you this information that cash receivable and closing stock are this much, and the company has payable, accruals, and bank overdraft of these amount, and the question is asking you to find out net working capital. So you can simply go back to your basic concepts, check at initial stage. Working capital means you will take current assets, you will minus current liabilities. So when you are working on this question, the question is asking you working capital. Take care that if word net is not given, doesn't make any difference. If question is asking you to work on working capital, you will take all current assets and you will minus with the current liabilities, and then the rest will be settled. So this is the solution. Current assets total is 25,000. Current liabilities is 7,500. So your working capital is 17,500. What is working capital? As you can see that I need 25,000 if I am interested to buy current assets. But if I couldn't get any liability, then I will need 25,000 fund. If I can arrange current liabilities 7,500, so the fund that I need to operate my business is 17,500. These are the concepts that may be taken and it affects on your cash flow, like collect receivable faster. If you are collecting receivable much faster compared to previous time, it means that you are releasing cash from the cycle. Let's just assume that earlier you were collecting from your customers after 90 days, and now in this year you are able to collect from your customers in 60 days. It means that you are collecting your receivable faster. If you are collecting receivable faster, it means that you are releasing your cash in much better way compared to previous year. And vice versa, if you are collecting receivable slower, earlier you were collecting in 90 days, now your business is taking 120 days or 150 days. It means that your cash is more engaged in the forms of receivable and you are unable to convert it into cash. It means every business is interested to see whether their collections are much faster compared to last time or their collections are slower as compared to the previous period. And of course they also investigate what are the reason behind it, why cash flow is in terms of receivable is changing. Get better credit from suppliers. Giving you an example, you were buying from a supplier and the supplier was giving you a 30 days credit. It means that if you are buying today, then you will pay this amount after 30 days. Suppose you are planning to deal with another supplier and another supplier offered you that rather than paying me in 30 days, I am willing to accept your credit for 45 days. What does it mean for the business? First supplier was giving you 30 days credit. It means that whatever you are receiving today, you are committed to pay it in 30 days. Suppose another supplier is giving you 45 days credit. It means that whatever you are buying today, you will pay to your supplier after 45 days. Can I say that this concept is taken as get better credit? Yes. This is called get better credit, means rather than taking it in 30 days, now you are taking advantage of 45 days. This is increasing your cash resources. If you have a simple business understanding, then you can understand that how under this situation your cash resources will increase. Shift inventory faster. Shift inventory faster. Just assume that you have a showroom where you have a four cars and you are earlier you were selling it in 30 days. Now the demand is much higher in the market and you are able to sell it in 10 days. What does it mean? Your inventory is converting into sale. You are making more turnover from your inventory. It means that you are freeing up your cash. Repeating it. Earlier, your business was taking 30 days to sell its inventory or to make sale. But now your business, due to any reason, is selling their goods in 10 days. It means that you are freeing your cash 20 days earlier. Of course, this is reverse of this situation. Just assume that the market is in recession. Earlier you were selling in 30 days and now you are taking 90 days to sell your stock. If you are piling a stock in your showroom, if you're piling a stock in your store, so naturally your cash is invested over there. Your supplier is demanding money from you and you are unable to provide them this cash. Reason? Whatever stock you bought, you are unable to sell it, you are unable to convert it into cash, so naturally it will create problem for you. So these are the things which are quite important for the businessman when he is dealing with the receivables, when he is dealing with the suppliers, and when he is planning to sell. So if receivables are collecting faster, much better for the business. If you are taking more better credit conditions from the supplier, much better for the business. If you are able to sell your stock much faster, this is much better for your business. Now try to work on this one. Compute working capital from the following data. So the first thing that you will do, it's very simple. Just find out what are the current assets and what are the current liabilities. So see, you have cash, you have marketable securities, you have receivables. So these can be taken as current assets, accrued expenses, current liability, bank overdraft, current liability, other current liabilities, and short-term loan. So if you can identify which item should be taken as current assets and which item or items should be taken as current liability. You can easily find it. Remember, at advanced level, we do not take all the current assets and current liabilities. There we take care that which information should be incorporated in current assets and in current liabilities. Here I'm giving you a simple and basic concepts that the student can understand that okay, this is the basic concept of working capital. Later at advanced stage we will take certain specific informations to calculate working capital. So this is the technique that you will apply. You will take all the current assets, you will minus all the current liabilities, and your working capital is 600. This is the fund that you need to invest in the business to operate and manage your working capital. This is cash conversion cycle. See, you have certain cash. This cash you are investing in material, and after processing material will convert it into finished goods. Finished goods, you will sell it, you will convert it into receivable, and receivable will move into cash again. Again, check the concept. You have cash, keep it in mind. You are investing this cash in the purchase of material, right? Now, this material is in your store. You are processing this material and converted it into finished goods, but your cash is still stuck up. You are unable to convert into cash. Now you are planning to sell this stock. Once you will sell this stock, then this stock will convert into receivable, and receivable will take time. Might be it may recover in 30 days, it may recover in if it's 60 days, and so on. So whenever this cash will recover, it will change into cash again. So this is the entire cycle which is followed by a manufacturing concern. I'm keeping it here simple for you. I'm not putting technical terms like material. When it is converting into finished goods, naturally there is a processing and it is taking time. When you are selling it, so selling will take time. It might possible that 10-15 days you have a stock in your store and then you are able to sell it. But whenever question is giving you cash conversion cycle concept, so cash conversion cycle means you will keep it in mind that here you are investing, this is shifting into material, material will convert into finished goods, you will sell it, and this sale will convert it into receivable. And when this receivable will come back to you, then you will say that now I am able to recover my cash. So don't forget to give your feedback on this concept. Just giving you a practical concept of this one. Like suppose you purchase on credit for all 30 days. This is your payable period. You will pay this amount after 30 days. Now this material converted into finished goods and it is taking processing time of 45 days. Means the material that you are buying will not directly go to the production floor and will not directly shift to finished goods. Material will remain in a store, then a demand will arise on the production floor and you will shift on production floor, you will take processing time, and then finished goods will be ready. What do you think? As finished goods will be ready and you will be able to sell it? No. Student, this doesn't happen like this. It takes time. So again giving you time. So here you are taking some time. This is 60 days. So 30 days credit you have. You will pay to your supplier after how many days? After 30 days. But student, carefully check. Your own processing time is taking 45 days. Your customers whom you are selling, they are unable to give you cash immediately. They will pay you cash after 60 days. It means that whatever amount you need, you have to calculate it that how much time you will take to recover your cash. This is actual practical example of cash conversion cycle. So the collection time will be calculated like this. This is your receivable time, this is your inventory time, and this is your payable time. So what formula you will use? Inventory period, how much time your stock is placed in inventory. Receivable time, the time which is uh, your customers are taking, and then you will minus payable time, uh, the time which is taken by you to pay to your suppliers. So when you add these two one and minus this one, the overall time period that you need to fund is 75 days. So this 75 days is called cash conversion cycle, that how much time your business is taking to. I hope that this concept will give you a basic idea, and in case of any issue, you can discuss me on the comments. And remember that these two concepts which I discussed over here, the one was working capital and the second one is cash conversion cycle, are very important when we are working in practical business, because these help us to understand that how we manage our business on daily basis. Thank you very much.